Hello students, let us move ahead with our learning of financial accounting. In this video, we will study about accounting principles. My dear students, financial statement and financial accounting is the product of the process in which the large volume of data relating to the economic activity of an enterprise is recorded, summarized and then reported. So, it is really important that this reporting and recording should be done in conformity or in uniformity to certain guidelines and rule, so that it is understandable by different stakeholders across the globe. If they are not written with generally accepted principles and generally accepted rules, then it will not be comprehensible by various different stakeholders. So, in this video we will study about different principles of accounting that is used for writing the books of accounts. So, before starting the main journalizing and writing the financial statement or making the books of account, let us first be clear with these accounting principles, because these are the guiding principles which will derive your decisions as to how to record a particular financial and economic transactions in books of accounts. These accounting principles is defined as those rules of conduct or procedures which are adopted by accountant universally while recording the accounting transactions. So, these principles are basically they represent the most current agreement about how accounting information should be recorded, what information should be disclosed, how it should be disclosed, and which financial statement should be prepared. So, in this video we will study about these generally accepted accounting principles. Generally, these accounting principles is under two categories: the accounting concepts and the accounting conventions. Accounting concepts, if I tell you, are the assumptions and ideas which are fundamental to accounting practices. These are broad assumptions which is actually derived, which actually underlines the writing of or the reporting of financial statement of business enterprises. In other words, these are fundamental accounting concepts which are generally in broad general assumptions. So, these accounting concepts gives you a guideline, gives you a rule as to how to report, how to record a particular financial transactions. First concept that we are going to study today is the business entity concept. This concept says that a business and its owners are two separate entities. They are not the same person. So, if Mr. A starts a business, A Limited, let us say, so A Limited is a separate legal person and Mr. A is a separate person, right. So, there are two different entities. A owner is separated from its business entity. Entity has its own artificial legal identity. So, A Limited is a person in the eye of law. A Limited can purchase property in its own name. A Limited can enter into any legal agreement or any legal transactions in its own name. So, business is separate from its owner, and this is the reason that we put capital under the liability side of the balance sheet. So, with every accounting concept, for your understanding, I have given one instance also, one example also where this concept is used while recording our financial transactions. So, we have seen that while writing the business statement or the financial statement, that is the balance sheet, we record the amount invested by owner as the capital under liability side. Now, how can the capital or the money invested by one person in its own business can come under liability side? Because liability is something that business owe. It is because the concept here is the business entity concept. So, A Limited is different. The amount invested by Mr. A in A Limited is treated as the amount owed by A Limited to Mr. A. So, it is recorded as liability side under capital in the balance sheet. So, whenever a person or owner of a company withdraws something from the business, its own business, so we take it as drawing, we take it as payment of dividend if it is from the final profit, which is also separate because business is different from its owners. Business has its own legal identity, it is an artificial person. So, for instance, when a person invests 1 lakh rupees in its own business, it will be treated that the business has borrowed that money. So, we record them as a capital under liability side. So, this is first important concept. The business is different and the owners are different separate legal entity. Next concept is the money measurement concept. Money measurement concept says that only business transaction that can be expressed in terms of money are recorded in the books of accounts. That means any transactions which has a value, but if it cannot be expressed in terms of money, then it will not be finding place in the books of accounts, and only the unit should be the monetary terms, the money terms. So, all other units like kgs or liters or numbers will not find a place in books of account. They may be recorded for some other purpose, but for writing books of account they must be expressed in terms of money. We need to express them as a value in terms of money. So, for example, for instance, there are certain organizations like IT companies where human or their engineers, software engineers are the most valued asset, but although they are valued, but they will not find place in books of account. We will not record our human assets in our books of accounts because they cannot be expressed in terms of money. Right. With advancement in accounting, now we also have a branch which is HR accounting, where we try to express them, we try to record them in our books of account, but in traditional accounting such transaction will not find a place in books of account, because the concept here is the money measurement concept. So, only the items, the transactions that can be expressed in terms of money will be entered in books of accounts. Next concept is the dual aspect concept. Now, what is dual aspect? Dual aspect means the financial transaction recorded involves two phases, two aspects that need to be recorded in a financial transactions. So, each of such transactions will be termed as one leg of transaction is debited, one is credited. So, every transaction will have two aspects, one debit and one credit. It will have a dual effect. So, dual aspect concept, that means in every transaction we have to recognize these two aspects, which two aspect is impacted, which two aspect will be affected by this particular transaction, and then the recording will take place. That means every time when you record a transaction, there will be two aspects that will have an effect. So, you have to identify them, and according to the rule of debit and credit we will be recording it. So, this books of account that we are writing, or the accountancy, basically has a dual aspect concept, right? So, for example, if a firm sells goods worth rupees 10,000, so this transaction has two aspects. Which two aspects? One aspect is the sales, which is rupees 10,000. That means you are going to have a income. This is a revenue which you record as sales. And another transaction is if you get money by selling this 10,000 rupees, then the cash will increase. So, there are two aspects of this. Once the sales will increase, another is the cash will also increase. So, you have to identify these two different aspects which is impacted by a particular financial transaction, and then the books of account will be returned using this concept, which is dual aspect concept. So, for every credit there will be a corresponding debit also, and this is the general rule. In our next video, following video, we will understand these rules of debit and credit for writing the books of account, for journalizing, for posting it in ledgers, and for making financial statements. Next concept is the going concern concept. This is a very simple and important concept. That means the show will go on, whether the owners or the stakeholders, or they will come, they will go, but the company is a perpetual, company has a perpetual succession. That means there is no idea of liquidating the company or winding up the company in near future. So, company is going to be there in future for years and years. So, this accounting concept is basically where a business is expected to continue for a fairly long time and carry out its commitment and obligations. Now, what is the implication? What is the instances where we are using this important concept? So, while recording the value of the asset, we record the asset at its purchase price, at its cost price, not at the price at which this will be sold in the market, or the current market price of the asset, because we generally take in this as a guiding principle that the company will carry on its business and they have no intention to sell their assets in near future. So, we are not recording the current market price of the fixed assets or other assets, we are writing them at cost. So, this is because we are using this concept, which is going concern concept, right. So, the sales value of anything means the assets will not be taken into consideration, their cost value will be taken into consideration, reason being the company has a perpetual succession. Another concept, accounting concept, is the cost concept. Cost concept says that the fixed assets of the firm are recorded on the basis of their original cost in the first year of accounting, and then they will be diminishing at some rate of depreciation in further future. That means the assets will be recorded at its cost price which is paid to acquire these assets. So, if a business buy a plant, let us say for rupees 10 lakh, the assets will be recorded in the books of accounts at rupees 10 lakh also, even if it has a market value of more than 10 lakh or less than 10 lakh rupees. So, this is cost concept, and this concept is basically applicable in case of fixed assets and in case of investments also. Company that has made an investment, the value of this investment will keep on changing according to the market, right? Market increase and market decrease, but we will not very often will change this price, we will record it at its cost only, because we are following what? Cost principle, cost concept. Next is the accounting year concept. Every business choose a specific time period for which they will be completing their cycle and for which they will be recording or they will be closing their books of account and then starting the new period. And generally this year concept, accounting year concept, is a year concept, but it can be monthly, it can be quarterly. In corporate world, in our country, we have financial statements reporting for quarterly basis only. So, every quarter the firm has to close its books of account for the quarter and give the result, share this result to the stakeholders, and finally at the end of the year all these quarterly books of accounts will be audited, and then the final account or the final annual report will be released. So, this is the year concept. Now, the year a company need to choose one cycle which is in the form of a year, and that can be a calendar year also, and that can be a fiscal year also. Fiscal year starts from 1st April to 31st March, and calendar year starts from 1st January to 31st December. But mostly, generally, in almost all the cases, the company chooses a year which is a fiscal year. So, they starts their new cycle, the new set of books of accounts on every 1st April. right? This is accounting year concept. Next concept is the matching concept. This concept is really very important for you to understand, because this is a guiding principle for understanding whether an expense will be entered in that year's profit and loss account or not. So, while deciding what to do with the income and expenses, various income and expenses, we need to understand this concept. This concept is simple to understand, and it says that for a period, for one accounting period, which is generally a year, when we are bringing or when we are calculating the profit for that year. So, to calculate the profit, all the revenue generated in that particular year should be matched with the expenses that was incurred to generate that revenue. In simple terms, what does this principle says? It says that for a period, if you are recording your income means your revenue, your sales, then all the expenses which were incurred to generate this revenue should be recorded in that year only, whether you actually pay for them or whether you actually receive them. But if they belong to that particular year, they must be recorded in that year's profit and loss account. That means the revenue should be matched with the expenses which was incurred to generate that revenue, whether actually the expenses were paid for or not. And this is the reason. And what are the instances where we are using this matching principle? What we do when we make a profit and loss account, we take into consideration the outstanding expenses also and the prepaid expenses also. Why? Because that outstanding expenses belongs to that period only. Although they are not paid, but they belong to this period because they are used to generate the revenue for that particular period only. So, it should be matched with the revenue. So, we take outstanding expense as expense only in the P&L account of that particular year, although they are not paid in cash, they will be paid in future period. Because why? Because we are using what? Matching concept. We are matching the revenue with the expenses which is incurred to generate that revenue. Similarly, if prepaid expenses are there in a particular year, so prepaid expenses does not belong to that particular period. They have no role to play in generating the sales or the revenue for that particular year. So, what we do, we subtract that prepaid expenses from the total expenses. Why? Because here they will be mismatching the revenue. So, this is the matching principle. It says the income made by the enterprise during a period can be measured only when the revenue earned during the period is matched with the expenses incurred to earn that revenue, right? So, this is the reason that we take into consideration all prepaid expenses, outstanding expenses, accrued income, all these things, because what we are doing, we are matching our revenue with our expenses. These were some of the concepts that we have to take into consideration while writing our books of account. Now, let us do another part of this video, which is accounting conventions. So, these conventions are generally the customs or tradition which is used as the guide to prepare the books of accounts or preparing the accounting statement. The difference between conventions and concept is that these concepts are the guiding principles for writing books of account, but these conventions give us a practical approach how to deal with certain transactions which are not actually taken care in accounting standards. So, they give us a way, they give us a line to think that what should we do in our practical way while deciding where should that transaction be recorded, how should that transaction be recorded, because there are certain transactions which are not being dictated, which has not been given in GAAP or in accounting standards. So, how to deal with these transactions? There are certain conventions. We need to just take these customs into consideration and then decide ourselves that how this transaction should be dealt in books of accounts. So, basically they are designed to promote consistency and help accountant overcome practical problem. that arises while writing books of account. We will see certain conventions. There are basically five conventions which we will study today. First is conservatism. Conservative is has the literal meaning as we have in English language, the dictionary meaning. While writing the books of account, we are conservative. Conservative here means that we take into consideration all expected losses, all contingent liabilities and losses. We will consider it and we will account for it, but we will not account for all expected gains. Why? Because we are conservative. So, we are writing books of account on this principle, on this conventions, which is conservative principle. So, this principle says कि when two values of the transactions are available, the lower value transaction should be recorded. Why? Because if the higher value transaction happens, it is good for us, but we are conservative, we are not overestimating anything. So, all unexpected losses will be taken into account. So, we make provisions for all unforeseen losses, like provision for bad debts, provision for discounts, but we will not account for any expected gains or profit. Why? Because we are conservative. So, this is one particular conventions where whether windfall or expected windfall or expected profit should be entered in books of account or not. So, we will take help of this conservative principle and we will not record it, but we will record all the expected losses, contingent losses, that is estimated, or that is there is a probability of happening something. In terms of losses, we will record it. Why? Because we are making our books of account as in conventions of conservatism. Another convention is the consistency. Now, consistency in terms of what? Consistency in terms of accounting, choosing the accounting principles. There are certain flexibility given by a gap given by accounting, where you need to choose one type of policy. But this principle says if you choose one policy, accounting policy, then you are expected to be consistent in writing your books of account with that policy only year on year, right. So, you cannot switch over the different policies year on year, because you need to be consistent. So, before explaining this, let me tell you what are the different type of areas, different examples where we have this accounting flexibility, where we have the accounting policies which we can choose. Number one is the method of depreciation, depletion and amortization. Generally, there are two commonly accepted depreciation methods, straight line method and written down value method. So, company has a choice to choose between any one of them. For income tax purpose, these guidelines are given by income tax authorities, but for accounting purpose, you have the choice to choose between these two policies. So, whichever policy you choose, you need to be consistent. So, if you are changing your policy very frequently year on year, then these are considered as a red flag areas. That means you are doing some window dressing. So, these are estimation distortions things, right. So, it is not generally a good practice, and here we are using this convention that we are choosing a policy and we will be consistent in these policies of this depreciation technique. Next is the valuation of inventory. There are different type of valuation of inventories available, like FIFO, LIFO and average method. So, company, if they are choosing one policy, they need to be consistent. Then the treatment of goodwill, valuation of investment, treatment of retirement benefits, valuation of fixed assets, conversion or translation of foreign currency items, at what point. If you are choosing one policy, you need to be consistent with that. Then treatment of contingent liabilities also. So, these are different flexibilities given by accountancy, where accountant or the company can choose which policy to be adopted, but they need to be consistent year on year with that policy only. Next convention that we are going to study is the materiality. So, material convention is very interesting. It says कि although every transaction, every economic activity need to be recorded, but the explanation or elaboration of the activities or the items which are not material can be avoided, and they can be just shown or recorded in consolidated way, in a collective way. So, for a company like Reliance Industries, where the turnover is in some lakh crore rupees, there let us say the petty cash item of some admin office is 5,000 or 10,000 a day, then it is not really very important to give a bifurcation of 10,000 spent on what items, right. So, they can consolidate it, they can just give it a name as a petty cash, and the explanation of that petty cash can be avoided being a part of this proper books of accounting, right. So, only the material information, that means we are not leaving any material or money information, but we are not making heads of it, right. We are just giving it in a consolidated way, because they are not significant enough, they are not material enough to be included separately as some item or some heads in books of accounts. So, this is just a convention, and there is no definition, there is no hard and fast rule. It depends upon the size of the business, it depends upon the nature of the business, the nature of the work. It does not mean that we are leaving out some information, but we are just leaving out the information which is not significant enough. So, the fourth convention that we are going to study is the full disclosure. Full disclosure entails the revelation of all information, whether it is favorable or whether it is detrimental to a business enterprise. That means any material value, any material information which is important for our stakeholders, all the creditor and debtors, should be disclosed, whether it is going to have a positive effect or a negative effect about the company. The full disclosure and the transparency has to be there. These days we are talking a lot about the these transparency issues, the corporate governance issues, and we carry this convention also that there should be a full disclosures. Why? Because management in big corporation is separate from the owners. Owners are external people. So, the full disclosure means the financial statements or the books of account should be written in such a way that it has all the material facts disclosed about the company, about the internal operation of the company to the external stakeholders. The last convention that we have in accountancy is the accrual basis, accrual conventions. Accrual is similar to the matching concept. In matching concept, we have to match the revenue with that year's expenditure, whether actually paid or not. Accrual basis is same. It says that if something relate to that particular year should be recorded in the income statement of that year, whether it is actually paid in money or not. So, revenue and cost are recorded when they are earned or incurred, when they have accrued, when they become due, whether or not they are received or paid during that particular period, but they must be taken into consideration in the period in which they belong. So, this is accrual basis of accounting, and while writing our P&L account, while writing our books of account, you will see that this is a very important convention, very important principle that we need to remember for deciding whether this transaction should be taken as the income or the expenses for that particular year or should be carried for next year by this convention, which is accrual convention.